Looking at Supermicrocomputer Inc. today, are we staring at a massive flashing sell signal in a falling trend? Or is this the ultimate strong buy for an undervalued AI giant?
I mean, that is essentially the most polarizing question in the tech sector right now. The divide between what retail investors are doing and what institutional funds are doing is, well, it's massive.
Yeah, and because that divide is so extreme, before we even pull up the first chart, I want you to hit that like button, subscribe to our YouTube channel, and it's compulsory that you leave your comments and feedback below.
Right. We really need to know what you think about this one.
Exactly. Are you buying this dip or are you bailing out? We read all your feedback, and the community consensus on this is going to be fascinating. So let's set the stage.
Let's do it.
Today is April 23, 2026. We've pulled a pretty heavy stack of sources for this deep dive. We're looking at Yahoo Finance, Guru Focus, CNBC, and some real-time order flow data from TradingView.
All the heavy hitters.
Right. And our mission today is to unpack the extreme volatility surrounding SMCI and really determine if this stock is a hidden gem just waiting for a bounce or, a very dangerous value trap.
But just to establish our ground rules before we really dig into those spreadsheets,
Yeah,
this deep dive is purely an analysis and debate of the data provided by these sources.
absolutely.
We're looking at market mechanics, the news, the financials. Absolutely no financial advice is being given here. You're entirely in the driver's seat for your own portfolio
Well,
decision.
you make your own calls. But before we get to the spreadsheets, we need to address the immediate bleeding. I mean, why the stock violently dropped today. Right now, the quote is sitting at $26.75.
Which is a sharp 8.33% drop today alone.
Yeah. And to really give you the historical context of that damage, you have to look at where it came from. Just back in July of 2025, this stock was riding the whole AI wave at a 52-week high of $62.36.
Wow.
And then fast forward to last month, March 2026, it crashed to a 52-week low of $19.48. Today's drop is just, the latest violent swing.
And it's driven by two very specific headlines. We're seeing a confluence of catalysts here, starting with a massive operational blow. Bluefin Research reported this morning that Oracle canceled a major contract with SMCI.
Wait, how major are we talking?
We're looking at an estimated $1.1 billion to $1.4 billion order that was just suddenly pulled.
Okay, let's unpack this because a billion-dollar cancellation in the hardware space is fundamentally different than in the software space, right?
Oh, completely.
Like, if a company cancels a $1 million software subscription, the software company just loses future revenue. But SMCI physically builds servers. If Oracle cancels an order of that magnitude, doesn't that mean SMCI is stuck with $1 billion worth of, physical metal and silicon they've already sourced?
That is the crucial distinction here.
Uh-huh.
AI servers require massive upfront capital. SMCI has to procure all the NVIDIA GPUs, the advanced liquid cooling systems, the memory.
And none of that is cheap.
Exactly. It carries incredibly high costs. So when a client like Oracle backs out, SMCI is left holding a highly specialized, incredibly expensive bag. And hardware depreciates rapidly,
Right, because if a new generation of chips is announced next month, those servers lose a significant chunk of their value instantly.
Yeah, but the Oracle cancellation, as damaging as it is only the first catalyst. The second is honestly an existential legal threat.
You're talking about the Department of Justice indictment.
Yes. There's a DOJ indictment alleging AI chip smuggling to China, specifically involving SMCI's co-founder, Wally Liaw. Wow. And compounding that federal probe, multiple law firms have filed class action fraud lawsuits regarding inadequate risk disclosures. And just to be clear, we are simply reporting the existence of these allegations as they're documented in our sources.
Right, we're not taking sides or making judgments. We're looking strictly at the market mechanics and how large funds react to the existence of federal charges.
Exactly. Because it creates a core issue of uncertainty.
It really does. It's like finding out your star quarterback isn't just benched for the playoffs, but he's actively under federal investigation. I mean, how does a company even operate under that cloud?
Well, compliance departments at institutional funds have very strict mandates. When a C-suite executive is named in a federal indictment involving national security and export controls, it triggers automatic sell protocols.
So they literally don't have a choice.
Many of these funds simply aren't legally or ethically permitted by their internal bylaws to hold stock in a company operating under that specific kind of federal cloud. It forces an institutional exodus.
Right. But, News headlines run on emotion, and institutional mandates are super rigid, though numbers don't lie.
No, they don't.
So let's transition to the fundamentals to see if the company's financials can withstand these legal and operational shocks. Because I'm looking at the income statement data from Yahoo Finance, and it looks like an unstoppable juggernaut.
On the top line, the growth is undeniably massive.
It's insane. Fiscal Q2 2026 revenue came in at $12.7 billion. That is a 123% increase year over year. Net income for the quarter sits at $401 million.
Yeah, they're essentially more than double their business in 12 months.
And trailing 12-month earnings per share, or TTM EPS, which is just how much profit they generated per share over the last year, is a very solid $1.31, according to CNBC.
Right.
So I have to push back on the market reaction here. If they are growing revenue by 123%, why is the stock collapsing?
Because if you stop reading the income statement at the revenue line, sure, it looks like a tremendous buying opportunity. But the underlying rot that the market is punishing sits slightly lower on the sheet.
The margins.
Exactly. The gross margins have collapsed. A year ago, SMCI was operating with an 11.8% gross margin. Today, that has dropped to 6.3%. The rapid scaling is coming at the direct cost of profitability.
Explain the real-world impact of that. Gross margin is what's left over after they pay for the raw materials to build the servers, right?
Think of it this way. For every dollar of server equipment SMCI sells, they used to keep almost 12 cents to cover operating expenses, research, and profit. Now they're only keeping 6 cents.
Ouch.
Yeah. They're paying absolute top dollar for critical components, especially the AI accelerators from companies like NVIDIA. But the server assembly market is so competitive, SMCI can't pass all those increased component costs onto their customers without losing the sale.
So they're essentially trapped. NVIDIA holds all the pricing power for the chips, and the major tech giants hold all the negotiating power as buyers. SMCI is just stuck in the middle.
That is the classic hardware middleman dilemma. They're scaling volume massively, hence the 123% revenue growth. But their profitability per unit is shrinking. The 6.3% margin leaves an incredibly thin buffer.
Right. If component costs rise even slightly, that 6.2% can vanish instantly. So let's test that buffer by looking at the balance sheet. Do they have a war chest to survive this margin squeeze?
Well, the data shows total assets at $14.39 billion, which includes a cash pile of $4.1 billion.
Okay, $4 billion in cash seems like plenty of runway.
It's strong, but you have to weigh it against the liabilities. They're carrying $4.78 billion in debt. So their debt load is actually larger than their cash reserves.
I see.
But the metric that truly exposes the strain on their business model is the operating cash flow. In Q2 of 2026, despite bringing in $12.7 billion in revenue, their operating cash flow was negative $24 million.
Wait, I need to make sure I understand this. They sold over $12 billion worth of product, but the actual cash generated from their core business operations was negative.
Yes.
How is a company that size bleeding cash?
It comes down to inventory investment. They're pouring astronomical amounts of cash into buying those expensive chips and building servers before they actually receive payment from their clients.
So they are spending cash faster than they make it just to hoard inventory. It's basically like buying a massive warehouse of groceries, completely emptying your wallet, and hoping people will pay a premium before the food goes bad.
That analogy perfectly illustrates the risk. When you have negative operating cash flow, you're relying on external financing to keep the lights on.
Right. And as we established earlier, AI hardware is incredibly perishable. If a $1.4 billion order from Oracle gets canceled, that warehouse of groceries just sits there tying up your capital.
Exactly.
Knowing that SMCI is burning cash on inventory, let's transition to the technical analysis. Let's look at how the broader market is physically trading the stock in response.
The trend is definitely something to look at.
Yeah, the technicals show a confirmed downtrend, and the price is trading well below its major moving averages. But there is one specific metric from TradingView that stands out. The 14-day RSI, or Relative Strength Index, is currently at 62.64.
Right, which places it in a neutral high, bordering on overbought territory.
Wait, if the RSI is nearing the overbought or high neutral territory, shouldn't that imply some recent buying strength? Like, if a stock is crashing down to $26, the RSI usually drops, signaling it's oversold.
Context is everything in technical analysis. Seeing a high RSI in the middle of a steep, confirmed downtrend is often the fingerprint of a failing momentum rally.
Or failing momentum rally.
Imagine flooring the gas pedal on a car that's stuck in thick mud. The tires are spinning incredibly fast. That represents the high RSI, a sudden burst of energy and volume.
Oh, I get.
But the car itself is just sinking deeper. Buyers tried to step in and push the price up, causing that short-term RSI spike. But the momentum is actively failing to sustain itself because the institutional selling pressure, the mud, is just too heavy.
The buyers are getting exhausted, so where is the floor?
Immediate structural support sits at $24. But the critical psychological floor is that recent 52-week low we mentioned earlier, $19.48.
And if it breaks that?
If the market pushes it below that level, there is very little historical price memory to stop it from falling further. Meanwhile, heavy resistance is capping it at $30 and $35 on the upside.
And the TradingView order flow data tells us exactly who is moving the market. It shows high volume selling, specifically breaking through the $29 level.
Right, indicating major institutional offloading.
Yeah, that isn't a bunch of retail traders selling from their phones. But here is a massive red flag to me. If the institutions are fleeing because of rigid compliance rules, you'd expect the insiders to be buying up the dip, right?
You would.
Yet there is a distinct lack of open market buying from SMCI's top executives. The insiders aren't buying the dip.
Insider buying is heavily monitored because it's the ultimate vote of confidence. When executives use their personal capital to buy shares, it signals they believe the stock is deeply undervalued.
Could they just be in a blackout period before their May 5th earnings?
Blackout periods do exist, sure, but the data tracks insider activity over a much broader window. The stock plummeted from $62 down to the mid-20s over several months, and the executives largely just sat on their hands.
Wow.
If the people with full access to the internal financial dashboards aren't willing to risk their own money, it forces the broader market to question why.
Which leads us directly into what the professional analysts are advising, and really the core debate of this episode, it's the deep dive. Is this undervalued or is it a value trap?
Well, looking at the analyst ratings, the consensus across the major desks right now is a firm hold or underperform. The average price target is $33.20.
But there's a glaring negative signal there too, right?
Absolutely. Bank of America recently stepped in and aggressively slashed their price target down to $24. The short-term outlook is incredibly bearish, especially with those May 5th earnings approaching.
Okay, so that's the bearish side, but let me throw a wrench into that. I want to look at the undervalued argument. Guru Focus estimates a fair value for SMCI at $81.04.
That's a huge gap.
Here's where it gets really interesting. That implies the stock is insanely undervalued right now. How does an algorithm look at the exact same company as Bank of America and decide it's worth 3 times as much?
Because algorithms and human analysts weight risk very differently. An algorithmic fair value model is heavily dependent on historical financial inputs. It sees the 123% revenue growth, the massive top line, and projects that forward mathematically.
So retail sees an $81 fair value and a $26 price tag and thinks it's a massive discount.
And that dynamic is the textbook definition of a value trap argument. Retail traders often get lured in by the mathematical discount, completely ignoring the downside risks and volatility.
Right. The algorithm is blind to the legal liabilities.
Exactly. An algorithm can't price in a DOJ indictment. It assumes business as usual. It doesn't know that federal export bans could structurally, permanently impair the business.
A value trap looks cheap based on yesterday's numbers, but keeps falling because tomorrow's numbers are fundamentally broken.
You nailed it.
Yeah.
If the DOJ revokes export privileges or legal fees wipe out their cash, that $81 target is meaningless.
Right, taking all the financials, technicals, and legal drama into account. Let's synthesize the absolute best and worst case scenarios for the listener. The bull case versus the bear case. I'll outline the bull case, the recovery scenario.
Go for it.
The upside argument relies on the sheer scale of the AI revolution. Projected FY 2026 revenue is still massive at $40 billion. If they actually hit that, the cash flow is monumental.
It is.
The bull theory suggests that if the DOJ probe clears with just a slap on the wrist, the AI demand is still robust enough for a massive long-term recovery. This is a bet that the market has simply overreacted to the legal headlines.
If we connect this to the bigger picture, the bear case points to structural damage. The worst case is a continuation lower.
Break that down.
The DOJ imposes severe fines or export bans to China. Long-term growth is crippled. At the same time, margins remain squeezed because they have to slash prices to liquidate canceled inventory like the Oracle order.
Right.
Suddenly, their debt becomes a suffocating weight. The stock crashes right through that $19.48 floor, and the company enters a multi-year freeze, fighting for survival in court.
It really seems like the short-term versus long-term outlooks require completely different mental
In
models.
the short term, the consensus is highly volatile and bearish due to the impending May 5th earnings and those legal clouds. Trying to trade this next week is incredibly dangerous.
And long-term,
Long term is a pure binary gamble on the outcome of the DOJ investigation. You aren't betting on their forward revenue. You're placing a wager on their legal defense team.
which brings us to the summary of this whole deep dive, the extreme duality of SMCI. We have a company with 123% revenue growth that is simultaneously hemorrhaging cash, bleeding margins, and fighting federal indictment.
It's the paradox of hyperscale growth without structural stability.
Exactly. They aren't truly an AI company. They are a hardware middleman taking all the inventory risk for a tiny sliver of the margin.
Which leaves us with a final provocative thought. If SMCI misses its May 5th earnings next week amidst this DOJ probe, will that historic $19.48 floor hold, or is the broader AI hardware bubble starting to burst for the middlemen?
That is the big question. So what does this all mean for your portfolio? Are you seeing a generational buying opportunity disguised by panic, or are you staying far away from the falling knife?
Let us know.
Drop your personal verdict in the comments below. Reminding you once again to like the video and subscribe so you don't miss our follow-up. No financial advice here, just deep analysis. Until next time, keep digging into the data.